Hi, I'm Aditya Nain.
Hi, I'm Narayan.
So I'm a financial consultant, educator, and writer with expertise in Indian and North American investments.
And I'm a cyber law professor and an intellectual property rights professor, and I'm a complete novice in this field. And welcome to the Nain and Narayan show.
Let's go. What do you want to
So,
talk about, Gokul?
Aditya, in this episode, I thought we would demystify a little bit about the risk appetite. But before we get into that, basically trying to understand what the different types of investment options are. And I think I'm not venturing into the concepts of mutual funds and all that yet. But before that, at a more elementary level, just to distinguish between the various options available, like stocks, commodities, or bonds, or something like that, because I was confused
Yeah.
initially when I got into it how distinct they are. So let's begin with stocks.
Okay. Uh, so yeah, and we will talk about these different things, Gokul, and maybe I'll also talk a little bit about mutual funds along the way because I think I want to keep that strain through these videos that
Okay.
we want to encourage people to invest through mutual funds, just because I think that's a great way for people to get started at least.
Okay.
Um, so we started talking about risk, and it's important for investors not only to realize that they have their own personal risk appetite, but that different types of investment instruments have their own associated risks. So what are these instruments? There are many, but you can say there are three basic investment categories or three different types of assets that you can invest your money in. So the most common that everybody knows about is stocks, which you can invest in through, let's say, an equity mutual fund.
Okay.
And typically, stocks are the highest risk of three categories that I'm talking about. Well, yeah, we'll leave it at that for now.
Yeah.
Then on the other side of the spectrum, you have um, bonds or fixed income instruments. Now, a bond is much less risky than a stock. And you can also invest in bonds through fixed income mutual funds or bond mutual funds. So you can either
Okay.
buy equity mutual funds or bond mutual funds, depending on how risky an asset you want to invest in. The third category is commodities. So the easiest way to think of that is gold. So gold is a commodity. And you can invest in gold just like you can invest in, let's say, HDFC Bank. You can invest in gold. And gold has its, or commodities have their own associated risks. Depending on which commodity this is, it can be a very high risk investment or a relatively low risk investment. So there's no one
Okay.
size fits all. But all these three, that is commodities, fixed income, and equities, have their own risk. Um, and so, basically investing in an equity fund is like investing indirectly in a bunch of different stocks. So a little bit of your money goes in HDFC, a little bit goes in ICICI, a little bit will go in L&T, a little bit will go, in all these different places.
So,
Bonds,
but just to jump in over here, Aditya. First of all, the stock would be akin to buying a part of a company itself. So, for
right?
example, if I'm buying stocks, I'm not going into mutual funds yet, but if I'm buying stocks of, for example, HDFC, like you said, then I'm buying a part of the company, and then my investment value increases or decreases as per the performance of that stock or that company on the share market.
Yes, absolutely. So these, let's just take HDFC just because it came to my mind, right? It's one of the biggest companies now in India. So HDFC, you can own part of HDFC, the company, by buying stock of HDFC. Now, this stock is traded on an exchange, so people buy and sell this stock. And if the buying activity is greater than the selling activity, then the price of the stock rises. If the selling activity is greater than the price of the stock falls. It has it's not entirely related to the underlying performance of the company. It's just related to the buying and selling of the stock of the company on the exchange.
Okay.
Um, And so, because it's related to people buying and selling these stocks, and this happens so frequently, and there are lots of fluctuations, the risk associated is more.
Okay. So
So,
how is this different from a bond? I've heard government bonds are safer to invest in. What's the difference between, therefore, a stock and a bond? When I'm investing money into a bond, what am I actually investing into?
so a bond is almost like a loan where the, let's say a government bond as an example. Suppose you give the government some money, whatever, 10,000 rupees. You give the government 10,000 rupees and they tell you we'll give you back 8% interest. Now, hypothetical, but let's say 10,000 and 8% interest. The government is obligated legally to pay you that 8% interest year on year.
Okay.
That's why it's safe, because there's a contract. The contract says that the government will pay the person they've taken the money from a certain interest, which is pre-decided. The government knows it, the investor knows it. So they are
So
bound.
irrespective of how the project in which the money is invested in goes, the government's obligated to pay you. If the project does really well and actually makes a lot of money, even then the amount that the bond has predetermined as interest will need to be paid, and only that much.
Yeah, absolutely. And that's the, you can say, the downside of it. But that downside is because of the great upside of it, there being a guarantee that you have to be paid that money irrespective of anything that happens. So
So is
if
there any chance of losing money in a bond also?
it depends on the quality of the bond and who's given you that bond, so to
Guaranteeing.
speak. Yeah.
Okay.
So for instance, a government bond is, or a sovereign bond is really the highest quality of credit worthiness of bonds, and you don't expect the government to default on bonds. If a government does default on bonds, then there are larger problems than your bonds. There's
Yeah.
probably some big social issues that need to be worried about. Riots on the
And
street.
that government's not going to last for too long, I presume. Is that Venezuela kind of situation where
Yeah, and
you
then
got,
you start, you have to create your own cryptocurrency based on the on oil and petrol. So there's stuff like
yeah,
that. So uh, yeah, and on the other hand, Gokul, to compare that to stocks, let's say an HDFC stock, HDFC is not obligated to pay you anything at all just because you bought stock, common shares in that company. Um, your investment growth or fall is just dependent on the buying and selling of that stock on the exchange. That's it. So it's people like you and me, a lot more money, who are buying and selling a lot of these stocks. And because of that activity, the price is rising and falling. If it happens
falling.
to
Yeah,
fall too bad, you can't take HDFC to court. That's the point. And so the risk
correct.
is higher, but the reward is potentially higher in stocks as well.
All right. And about commodities also, commodities also in themselves have different risks associated with them. Am I right when I say that? So, for example, copper will be very different from gold or silver, I
Yeah.
presume.
Yeah. So if you can think of two commodities right now that are in the news a lot, one is oil and one or crude, and one is gold. And they
Correct.
both have their own associated risks. So, for example, oil has a lot of political risk because the price of oil does not only change depending on market forces, so to speak, but also it's a big geopolitical pawn. So, if there's a big geopolitical event, countries may try and control the price of oil to their advantage. And so you can get stuck in the middle, right? And so that's a big risk with commodities. On the other hand, there's gold. Gold fluctuates for other reasons. So usually when people are worried about a financial crisis, uh, people sort of flee to gold because they think of it as this thing that has had value for so long. It's evergreen. It's always valuable. It doesn't, it has this aura about it. And so it may. So right now we're seeing that there's a crisis situation and gold has been increasing quite a bit. So there are associated risks with gold and with oil, and whether you invest in them or not depends on what type of investor you are and whether it figures in your overall asset allocation scheme, which we won't get into in this video, but we'll tackle it later.
So, just on the basis of defining investments on the concept of risk, would you say a stock, then commodity, and then bonds?
Yeah,
Would
so
you put it in that
bonds,
order?
yeah, bonds would be the least risky. I'm talking about good quality bonds, least risky, the
Yeah,
kinds that
obviously.
you should invest in. Yeah, commodities of these would probably be the most risky, just because it's so broad and it's affected by various different things. It's tricky. So, Gokul, I sense that your question is what's more risky, stocks or commodities?
Yeah.
And there's really no way to know that. It depends on which commodity. And so
Okay.
it's better not to get into commodities as a class on its own. But
All right. All
they're
right.
both quite risky, I'd say. I just leave it at that for now. Equities and or stocks and commodities can both be quite risky.
So if I were to put you in a difficult spot and make you choose between a stock, for example, HDFC, and a specific commodity, for example, gold, how would you then place it in the order of risk?
Okay, so personally, if I were forced to say which one is riskier, I'd say
Correct.
investing in just one stock, only one stock, whichever that may
Yeah.
be. It may
Yeah.
be the largest company in the world, but still investing in just one stock is riskier than investing in something like gold, which is an internationally traded commodity. Just for the simple reason that however strong a stock may be, it can fall tomorrow for any reason. And those of you who remember sort of Enron or Satyam, these are massive
Correct.
companies
Correct.
that
Correct. Correct.
whose fortunes fell from one day to the next. On the other hand, gold is a much more spread out commodity that is not reliant on just one board of management, not reliant on just one country, but it's traded all over the world. And no single person or organization can single-handedly take it down.
And also possibly because of the fact that it's historically been used as a system of exchange for so long. It's got historical backing for its reliability also, whereas HDFC in comparison to gold is a much smaller time frame that we're talking about.
Yeah,
Is
in
that relevant as
comparison to
well?
gold, I would say that would be true. It has an aura around it. A lot of that aura is also fictitious and sort of built up uh, based on the story of gold, you know. But yeah, it has a much longer history, and I think the point of it being globally traded and not being susceptible to, let's say, sabotage by just one organization or one group of people is important.
All right. So, however, we're still not commenting generally on commodities and stocks. They're both risky. They're both risky options in comparison. And I'm saying in relatively in comparison to bonds. So let's end with that idea in mind. Stocks and commodities risky depending upon which stock, depending upon which commodity. Relatively safer, lesser risk, lower return option is bonds because of the fact that it's a guarantee given by the organization issuing the bond.
Yeah, and if I can just add a point or two to that, when you actually invest, the idea would be to get a little bit of at least two of these asset classes, at least stocks and bonds, and maybe commodities, but at least two. And also keep in mind that commodities and stocks are more risky because typically they don't have guarantees, but bonds have guarantees that you will get paid a certain preset amount. Yeah.
Correct. All right, so that's it about this episode. If you have any questions for us based on the discussion that we've had, feel free to leave us a comment or, as usual, let us know if there are other topics that you'd like us to discuss. Thank you so much, Aditya, and see you in the next episode.
Thanks a lot, Gokul. Thank you, everybody, for watching. And if you like this, please share it with others like you who want to learn more about investments and follow us for our next episode. Thanks a lot.
Bye.